before somebody even makes an offer on a property, I'm saying, hey, let's get if at all possible, I need these 3 things.
Well, and what are those 3 things?
RR 105C or condo questionnaire, either one of them, insurance summary, and insurance certificate. So typically we need 35% down. Sometimes we can get away with less, but usually 35 for a condotel.
Condotel.
Yeah.
So then would you call yourself a mortgage banker broker? Because you are overlapping it.
Yeah, and I'm about to be able to call myself a mortgage banker broker bank.
Well, hi, everybody, and welcome to the Hawaii Real Estate Soapbox, where we talk bluntly, honestly, and sometimes we even rant about all things Hawaii real estate, living in Hawaii, and moving to Hawaii. The goal is to help educate, inspire, and entertain consumers and realtors, and allows you to make better, more informed decisions. You can find me on the web at hiestates.com. So today I'm joined by Keri Shepard, Regional Sales Manager and Loan Officer with CMG Mortgage.
Yes, sir.
So anyway, thanks for joining me, Keri.
Yeah, thanks for having me.
So tell the viewers a little bit about yourself.
I've been working in Hawaii in mortgages for a little over 20 years. I think you and I started almost 2 decades, if you're going to make me say that. I think you and I kind of started together. I feel like we sort of grew up together in the business. But born and raised in Hawaii, moved around a lot. My dad worked for the government, so I moved around a lot. So I've lived a lot of different places, but Hawaii's been home. I got back here middle of my freshman year in high school, went to Kaiser, went to UH, and been doing mortgages here forever.
Yeah, and so you do most of your mortgages here in Hawaii, but you're licensed.
I'm licensed in 20 states. Correct. And CMG is actually licensed in all states. So if I'm not licensed in that particular state, I have somebody in another state that can handle it.
So what percentage of in-state versus out-of-state loans do you do?
I'd say I probably do 80% in-state.
Here in Hawaii?
In Hawaii. All islands, though. Not just Oahu.
Yeah. So do you travel to the other islands? Because you're a regional sales manager. So
I used to more before COVID. Just starting to get back into it a little bit more now.
So a little bit about what I wanted to why I wanted to have us on and talk is we have conversations all the time. I have my financials with you pretty much 24/7.
Right.
With me doing the development company and doing investments plus having clients and whatnot, we're constantly kind of talking loan programs, strategy, this and that. So part of it, I wanted to talk about some topics, but also allow people to see a little bit of the back and forth so they can kind of see how the dynamic works and whatnot within the industry and some of the important components of the team that you surround yourself with.
Right.
So let's start off with the big topic that's kind of out there right now, which is condo financing and the issue that's been going on with condos. So I'll give a little brief background. Condo insurance premiums and condo hurricane insurance premiums have gone up significantly.
Right.
And so the background on this is the reinsurance market has taken huge losses in the last couple of years around the world from catastrophic events, from climate or from weather.
Natural disasters.
Correct. And in doing so, they're basically rewriting the models of how they underwrite insurance, which has caused premiums to significantly go up. In fact, and so there's 2 components there. There's the condo master policy.
Right.
So if a building has a lot of, let's say, plumbing issues, plumbing leaks over time, and they're having to file with the insurance company, those have been an issue and those premiums have gone up significantly. But the condo hurricane one is the one that's kind of been impacted.
The one causing the most problems right now.
Correct.
Right.
Some of their premiums have gone from, say, $25,000 a year to $125,000 a year. They've gone up significantly, even well over 100% in some instances. And condo boards are having to make a decision, okay, if we cover ourselves full 100% coverage, then we're going to have a significant maintenance fee increase or an assessment to the owners, or this other decision that the board members are making potentially is maybe we don't cover 100%, we go with a shorter amount to save on some of that cost, and in doing so, that comes down to affect financing.
Correct. It comes down to affect conforming financing. So, most buyers are hoping to get a loan with Fannie Mae or Freddie Mac. So their current requirements are you have to have 100% rebuild for hurricane. If you don't, you cannot finance through them, right? And I actually...
And so you said Fannie and Freddie?
Correct.
Which is a majority of the market.
Well, it's the entire market for conforming conventional financing, right? Yeah. There is.
So explain that real quick.
So Fannie and Freddie are they're entities that basically allow us to get the best rates, have the least amount down. They allow for first-time homebuyer programs. They allow for cheaper mortgage insurance premiums. There's just a lot of flexibility. They were really created for first-time homebuyers, right? And it's expanded into second home and investment financing as well. But that's their primary focus. So in a perfect world, buyers want to go through them to get their financing.
And usually rates that we see online and things, if people quote them, are going to be
usually
the conventional Fannie Freddie.
Right. Because they're your best price programs.
Yeah.
Yes. So we're just seeing, I actually looked, and I knew I was going to talk about this. We're doing a lot of condo reviews, right? So I'm getting condominium docs, insurance summaries, insurance certificates from all kinds of agents, and having those properties reviewed to see what financing is eligible. And right now, it's about a 60 to 65% that they are not eligible because of hurricane.
So I saw an article that said over 400 condo buildings in the state of Hawaii, which condo buildings means townhouses too?
Correct.
Okay. So
we've seen it more on the high rises though, than the townhomes.
I would assume the townhomes aren't as, I mean, you're talking about, when you're talking 100% replacement cost,
right?
Concrete structure that's 400 feet tall, that's significantly different than a two-story frame construction in a townhouse component. So I can understand that. So it is now affecting, why is it affecting the mortgage market now? Is it because you're saying 65% of them that you're coming across are non-financeable on the
because of the hurricane
side?
Correct.
And is it because the boards are not covering 100%? They're choosing to cover less?
Yeah, exactly. Yeah.
Which is an interesting thing, because a lot of times board members, I've sat on condo over a decade, plus having created condos. Most of those condo board members probably are not in our industry and don't even think about the impacts. Which
from a financing standpoint or a saleability,
Yeah, so you're impacted in two different ways when that starts to happen. One is, if you can't get financing on the property, then, okay, now you're talking cash buyers, you're talking a very small buyer pool, and okay, now you're crushing values in your building. The second component is if somebody in the building wants to do a refinance,
absolutely,
now you're going to run into them.
And I think we're gonna come across that, because as rates start to drop, right, and I have people reaching out to me to refinance. It used to be I was just worried about, does this rate situation make sense for them? Now, if it's condominium, I have to make sure that I can even refinance them conventionally, even though a year ago I closed them, on a conventional loan.
Yeah. So conventional financing is not the only option, but it's a majority of the market.
Right. It's the most affordable, and it's going to give you the best rate.
Yeah. So if a building does not qualify for the conventional side, now what do you do as the lender? You're looking in the portfolio side, or? Yes,
we are looking in portfolio, but the issue we're having with the hurricane piece is that even on the portfolio side, hardly anybody wants to do these. They see it as a pretty big risk to not have the 100% rebuild. So the company, CMG, actually we're one of the few lenders in the state that I am aware of that will finance these if they meet all other Fannie and Freddie guidelines, right? So if it's considered warrantable by all other definition, we can do the loan.
And that one piece is the only piece that does not. Wow.
Yeah.
A lot. I'm assuming there's a laundry list of.
Yeah. I mean, so we have to review it just like we're reviewing it for a Fannie or Freddie approval, right? We do everything else has to fit in that box. Yeah. If that's the one check mark that doesn't fit, we're okay. We can do that financing, but it is more expensive. It's a higher price loan because it's a higher risk loan.
Higher risk, and then, but so is that classified as a portfolio loan then, effectively?
Essentially.
And so explain portfolio loan real quick.
Portfolio is basically, it's a term I think in our industry, we just sort of throw around for anything that doesn't fit in a conforming box, right? So it basically just means it's a loan that a lender is going to keep on their books. They're not going to sell it on the secondary market or to Fannie and Freddie, right? They're going to hold on to it or securitize it in a different market. So it's not saleable to Fannie and Freddie.
Yeah.
But we also have other portfolio programs. So Bank of Hawaii, First Time Bank, some of these local lenders, they have portfolio products, but they won't portfolio condominiums with these hurricane issues.
I've seen they've started doing some special programs similar to what you're doing.
For as a hurricane?
Correct. And it's so for my side on the process, I basically, on the listing side now, what I do is I get that full condo package, which I did before. I mean, how do you...
You're one of the few people that do most... I think
they don't want to spend the money.
Right.
Which is...
I'm like, you're going to spend the money going into escrow. Yeah. You're going to go spend the money on...
And then fall
apart. Like, why not spend a couple $100 up front to find out what kind of offers you?
Yes, let's look at the grenade before we get before it blows up on us in escrow.
Yeah, that I just
that should be a common practice, but it's not.
It is
here in Hawaii. It is most times I see it as when I ask people, "Hey, do you have the condo docs?" No, we'll wait until an escrow.
Right.
I'm like, it's $500.
Right.
So we're basically needing to pull those docs ahead of time. I look through them. I look at reserve study and other things, but then I'm going to pass them to you or lenders, whatever, and then have you guys take a look at it in this market, because I need to know, can we get financing? If so, can we get conventional?
Right.
Is it going to be portfolio, or do we not have an option?
Exactly. Or is it going to be cash?
And if, depending on which one of those three it is, your condo's value is way different value.
Absolutely. And so I don't think a lot of realtors are getting that. I actually sent an email out the other day. I don't know if you saw it, but it was just said, subject line was, is your condo financeable, right? And it basically broke it down and said, hey, if you're a list agent, here's what you should be doing. If you're a buyer's agent, here's what you should be doing, and talking to them about ordering condo docs up front and what we're going to look at and all of those things, and just sort of telling them, like, you're not doing yourself or your clients any favors if you don't do your due diligence. Now, and even for me on the pre-approval side, before somebody even makes an offer on a property, I'm saying, hey, let's get if at all possible, I need these three things.
Well, and what are those three things?
RR 105C or condo questionnaire, either one of them, insurance summary, and insurance certificate. So I can then send that to my condo team and say, hey, I need you to review this and tell me, or what kind of financing we're looking at for this property.
So those are the only things you're going to need, or you're...
Well, those are the ones that matter the most right now, right? Because those will pretty much show if there's red flags. So what we're looking for is they're warrantable. When we're looking for a warrantable condo definition, right? We can do what they call a limited review, meaning I don't have to look at the budgets. I don't have to look at the finance. I don't have to look at all of that. If a borrower's putting 20% down because they're 20% down on a primary or second home and 25% down for investment, then we don't have to look at all the other stuff. It's actually 10% down, but then you bring the mortgage insurance piece if it's less than 20.
And
right?
Yeah.
So
the condo questionnaire, or the RR 105C, which you posted, just for FYI, the property manager fills that form out when we order the condo docs, and it answers questions: number of people delinquent, owner occupancy percentage, are there assessments, are there lawsuits, et cetera, et cetera, et cetera. That's what that questionnaire is. It answers a whole bunch of questions that you, on the lending side, can take a look at and quickly kind of maneuver through and figure out what is the status.
Are there any red flags here, right? So it's not to say that we order those three things and we don't need something else, but that's sort of the starting point. We can tell pretty quickly by that document if there's going to be some red flags.
If you needed to look further into other docs, is more or less what it is.
Correct.
Yeah.
What are you advising your clients when they're looking to purchase or sell a condo right now?
That's a good question. I mean, I make them aware of the situation. We walk through it, because, so I think there's a couple of things. Is there an opportunity here for a buyer? Absolutely. Because if you can't get insurance, how many buyers are you competing with?
Right.
When do you want to buy a property at the best value? You buy on bad news, sell on good news. Well, we're pretty much at the bottom of the market because rates were high.
Right.
And in doing so, we've started to increase on the number of sales. Condo side's down. Condo side is down now because of the insurance thing. So you have bottom of the market because interest rates are high. Then you layer onto it this condo insurance issue. Okay, well, if you want to buy on the discount, there's an opportunity here, but there's risk. And that's what we have to talk through, because if I have if you have a cash flush client that it's not that big of a deal to them that they can weather this out. That's the other thing too, is how long are we holding for? Right. How long are we buying for? Because you got to weather the storm if you're buying this. And what is our strength, financial strength? If you are a 100% down or very low down buyer who's squeezing into this condo that can't afford a maintenance fee increase the next year, okay, we need to have a conversation. Yeah. Because if the insurance premiums do go up and either there's an assessment or there's another increase in your maintenance fee and it's a significant amount, we don't want you getting into trouble. I've only had one client my entire career get in trouble, and that's because they didn't listen to me. So that's something that's important to me. Is it's not just about the sale. We're trying to set that financial foundation and build wealth for someone, help them build wealth while having a roof over their head. So it's just making people aware, and then it's case by case. Mm-hmm. It's condo by condo. And part of what it is I normally go through the condo docs. I go through the reserve study in detail. I explain to my clients how this all works, since I've sat on boards and have created them. And I go through the declaration of the bylaws to make them understand you're buying into a community. You have people to your side, above you, down below. So you have to have all these rules in place so you can enjoy quiet enjoyment. And who maintains the hallway, and how does that work? And what are you responsible for versus the association? Well, all that's spelled out in your condo docs. Most people don't read it.
Which most people don't read.
Correct. Yeah. But there's a simple concept, because it's all off of Hawaii revised statutes for condo law. They go off of the condo law, so they're fairly similar. They have differences, and so we walk through them. What's the definition of a unit, things like that. And so it's more just an education process, and then some guidance. Hey, should we be doing this? Are we in that financial place? Can you absorb an increase if it happens? We can get into the reserves to see, okay, do they have enough money in the reserves where it's less risky of a building? Or they're financial, 100% funded, et cetera. But that's more or less it. It's walking it through it. And if there is significant risk there, okay, here's the information so that you as the consumer can make the right decision.
Right. And we're finding too that, I have a client right now I just approved. He can only do $300,000 down for a condominium, and he can only do 10% down. So what we know with that guy is he has to get a warrantable condo. He cannot. Even if we have a program we find a property, it fits all the criteria, except it doesn't have the hurricane. Well, he has to put 20% down on that building, because we have to avoid mortgage insurance, right? So his only option is to find a warrantable condo.
Yeah. And then for me on my side, even if it is warrantable, we want to look at the results.
Right, exactly. So there's a lot of layers in condo financing right now. I thought condo financing used to be difficult. It was a piece of cake before. I wish we could go back to those days. I sound like an old person, but I do. I wish we could go back to those days.
Well, and it's getting more difficult too, because having sat on boards, I've seen the good and the bad and the ugly, big time. And in doing so, there's always tug between owners, which is, don't raise my maintenance fees. Hey, we need to fix these things the right way, invest the money, spend the money to get it fixed the right way. Hey, no, put a Band-Aid over it.
Right.
And so what you end up having, especially in buildings where you have deferred maintenance in a lot, and you're talking about a lot. Our boom period was the 60s and the 70s after Hawaii became a state in 1959. So you had you have a lot of condo buildings here that are in the 60s and 70s. So you're talking some of the major components like plumbing, elevator modernizations. Plumbing is the biggest one. Mm-hmm. And if you have a leak starting on the 40th floor and you damage 10 units and you're constantly as an association just patching, and you keep having these leaks and issues that affect multiple floors and you're tapping that condo master policy all the time, that's why those premiums are growing. So even how the building is managing itself is important, which means for me, like when I go to show condos now, and I've done this for a long time, just having sat on board, I pay attention to the components that are going on. My client doesn't need to. I will point certain things out. Hey, new elevator. They did an elevator mod. exterior of the building is painted very well. I don't see a lot of spalling cracks. I don't see a lot of issues. There's not a lot of deferred maintenance. If you can visually see a lot of things, if the big components aren't taken care of, you can pretty well sure that the other stuff is probably not as well. Right. So it's understanding what you're buying into and being comfortable with it. And there's no right or wrong way to also fund a condo building. For example, a 32-unit building like the one I bought in, they're not going to fund 100% to their reserves,
right?
Because your maintenance fees would be through the roof. I understand that building is going to have an assessment every 10 years. Okay, let's understand that, put the money to the side so you don't have the grenade go off, right?
Right.
Other buildings run at almost 100% funding. You get a 400-story tower with 600 units at a very well-run board. They have everything covered, and like, okay, you can have less money in a reserve because there will be some.
Right. No, deferred maintenance is another big issue that we're running up against. Deferred maintenance and special assessments. Those are other things that beyond the hurricane piece can blow up a deal.
Yeah. Which all impacts the financing. What do you think is the solution and why?
I don't have a solution. However, I'm being told that they are looking at the hurricane fund as a solution. I don't know how that's going to play out, right? The problem is insurance, the required insurance is not affordable. That, to me, when you break it down to it, that's the bottom line. So how do you fix that? The Hurricane Relief Fund has, I don't know how much money there is in there now, but I'm being told that it's being looked at for an option to help fund some of that. I think the other part of that is, though, while it's still expensive, it's not, my understanding of the Hurricane Relief Fund, it's not going to make insurance less expensive, right? If I'm understanding it correctly.
So it's like the difference between going to Lloyd's of London for that gap insurance versus having the state supplement it for a while. So it probably would be more affordable than going to Lloyd's of London. That's one. So
have you heard that as a solution too? That they were looking at tapping?
That was what I kind of figured coming out of the gate they would need to do as a stopgap, which they've talked about.
Right.
And I was on a webinar the other day where they were talking about it.
Right.
So a couple of things that that secondary market for reinsurance had supposedly is leveled out. So the hope would be we don't continue to have the increases, but we've already had the increase. So you go sideways at that point. That's hopefully it stays in that position. But I see a couple of things here. One is buildings are probably going to have to refocus on how they maintain their buildings, and part of that, there may be additional things that need to be done to help move those condo buildings into a less risky position from an insurance standpoint.
Right.
Taking extra steps from a maintenance and an investment standpoint so that your premiums can be lower. Right.
That usually means higher maintenance fees, right? How
yes and no.
How else can we fund that, or how else can they budget for that?
Well, you budget for it is what you do. And yes, if you're adding elements in, would it be more expensive? Yes. But I would argue, this is my thinking, and this is where I've butted heads with my previous board members, where their cost versus investment is. I'm more of a believer in investing the money, get it there, than, okay, let's have a $70,000 leak that we just had to deal with. Oh, now you have 5. Like that compounds and adds up quick, and that drains your reserves. Those are unexpected items. Okay, you can at least put the investment stuff on the books, prevent things, get it repaired the right way. To me, that's far less expensive and less costly, and you're not having to go to your insurance carrier who's going to jack up your premiums or drop.
I was going to say, or drop you. I just had a client the other day, actually it's one of our clients, and he got a notification in the mail that the insurance carrier was not going to reinsure the building. So he had to go find different insurance. And when we dug a little deeper in the insurance, said, yeah, there's just been too many claims in this particular building. So,
and that can come back to board, the association, how they maintain it.
And from a lending standpoint, we look much more favorably on a building who is investing, and doing preventative than somebody who's handling deferred maintenance, and special assessment. So everybody wins if you're proactive and you're investing for the future?
So here's why I think the state's going to have to step in. They're going to step in and they're going to have to. Housing is already not affordable here in Hawaii. The median price is over $1 million. The concept of owning a home is different now than it used to be. You buy a condo, an affordable condo, what you can afford, then you trade up and trade up to the townhouse, trade up to the single family home down the road. So if you're looking to get into housing, the natural path here, especially on Oahu, where there's like 65% of our inventory is either condo high-rise or townhouse. You go into the condo component because it's more affordable, right? Okay, well, the hurricane insurance component and the condo insurance component is now preventing affordable housing in a significant way, impactful. And I put it this way. Okay, interest rates went up to 8%. It's not that you can't get the loan. You can get the loan, but you qualify for less.
Right.
When the condo can't get a loan, the whole building can't get a loan on it, that's different. You have to pay cash. That eliminated everybody that wants to get a loan. And if you're looking at it from an affordability standpoint or affordable housing standpoint, you now have significantly reduced that market. That's a real crisis problem to me on Oahu, which would force the state in some kind of way to step in, which the hurricane fund should be that route. But that's not the solution. It's a stopgap. And then there has to be pivots and adjustments on the condo association side and the homeowners taking the responsibility.
So what do you see as the solution then? The hurricane?
It's a temporary solution.
Yeah.
It's the hurricane fund. It's the state stepping in with the hurricane fund, which I think the governor created an emergency task force. So it's the question is when? How long does it take for the government that?
Because didn't they try and pass something in May?
And it didn't pass.
Yeah.
Now it's getting revisited, but it may get revisited from the governor directly.
He needs to.
As like an emergency proclamation.
Right.
In summary, as much, so we want to make light on it. It's not, I don't think you become fearful of it. You need to become educated.
Absolutely.
Knowledgeable. Understand what you are buying when you're going down that path. And there's a bunch of things on the back end. We constantly are having to go just basically analyze condos. That the best thing that listing agents can do, we have a supplement section in MLS. You upload that insurance component into the summary or into the supplement section so we can easily click on it and grab it.
So I didn't know you could do that in the MLS.
I saw a couple agents doing it.
That's really
Those are proactive agents, right?
So if they order condo docs, can you upload them in the MLS?
The whole condo docs is a massive file. I mean, you're talking probably 20 different documents in a massive bunch of component of files. We wouldn't do that. But I mean, the key is you order the stuff up front because you can't properly price the unit without understanding the components of what's going on. I mean, if there's an assessment coming down to 30, 40, 50,000, and you see it right there.
Yeah.
If you didn't get the condo docs, you're mispricing the property. Now you've done a disservice to the seller.
Right. And then you can advertise in the MLS too, right? Like Fannie Freddie approved condominium or whatever, right? Which to me is
there should
that in
be
of
some
itself
proactive steps up front by us on the realtor side, but and then on the buy side, we need to get them to you, which goes to me emphasizes, especially right now, the importance of the team you're working with, the people that you're working with. They need to be knowledgeable and experienced in this situation, and that's not just on the realtor side, but you got to have it on the lender side, and they need to be working hand in hand.
Yeah, agreed.
But there's an opportunity because buy on bad news, sell on good news. That means there's discounts on the condo side, and for those that can tolerate some component of risk, and you try to make a calculated risk, there's a good opportunity there.
Yeah, I don't think it's going to be I don't think it's going to be a forever problem.
Correct.
I think Fannie and Freddie will eventually have to make some changes on their end as well in terms of
that's the other
component. Yeah, in terms of what they think is enough in terms of the condo or the hurricane coverage.
So talk on that real quick, and then we'll move on. But right now, Fannie and Freddie require 100% replacement, and so one part of the argument that's a building collapse,
right?
And so part of my argument to that, and why I don't feel that makes sense, is because a condo structure, when a hurricane comes, it's going to blow out windows, it's going to destroy the interior improvements, but your structure is standing.
Right.
And unless that building is in disrepair to begin with, really, really bad, I don't see the building coming down. So do we really need 100% coverage on that
and
for the loan side?
We definitely feel the same way as you do. I know that when the building in Florida imploded a couple years ago, right, that's really when all of these concerns with deferred maintenance came into play, right?
That wasn't a hurricane.
That wasn't a hurricane, right. But that's sort of what started Fannie and Freddie down this path of, and if you've had a mechanical engineer report done in the last 3 years, we have to see it, right? And you have to provide it to the lender so they can review it. So once that happened, there were they just started digging deeper. The hurricane thing, you're right, it wasn't from a hurricane. But that was the only time I'm aware that that was literally the building crumbling, right?
Yeah.
That had nothing to do with a hurricane. That was deferred maintenance.
Deferred maintenance. I've been in buildings where there's a chunk of concrete missing. You see the rust and spalling rebar.
That's scary.
And for it to get to that level is many years of spall.
Right.
Deferred maintenance.
Deferred maintenance, yeah.
So let's move to the next topic, which is financing for condotels or short-term vacation rentals.
Okay.
And I think probably we should define the two first, because condotels are different than short-term vacation rentals.
Right. You can technically have a condotel that you short-term rental, right? But for lending purposes,
are they two separate things?
Again, you can have one that does both, right? So condotel, and I'm just going to preface it with, everyone can have their own definition. But typically the way that we look at it from a conforming standpoint is it can't have like telephone service.
So let me back up and give the real estate side.
Okay.
Technically, a condotel is a condo hotel.
Right.
More or less a hotel room that you purchase.
Hence the name.
You own that hotel unit as a condo unit,
right,
and you put it in the hotel rental pool.
Right.
And a short-term vacation rental is not necessarily going to be a hotel room. It's going to be a condominium unit that you legally can do short-term vacation rentals in.
Right.
There's no downstairs hotel check-in desk necessarily.
Mm-hmm.
You can run it on your own.
Right.
That's kind of how it is on the real estate side. On the lending side,
so it's similar, but you can have a condotel that you choose not to put in the rental pool, right? We're still going to define it by the property, like the building, right? Like how is that building classified? So it can't have like maid service. It can't be in a rental pool. It can't have like phone. What is it when they call, phone to phone? When you can call the. Help me out, just Scotty. Yeah, no, when you can call, like you're in a hotel and you can call the other hotel room, right? That phone service, they define that as part of condotel. I know. The maid service, the front desk, you can't have a front desk. That really classifies that as a condotel. And then short-term rental, to your point, it's a little bit easier here in Hawaii because we're so strict about it, right? Like we can't, if it's considered a legal short-term rental, then it makes it much more difficult to get financing.
Well, but so to be clear, if you're getting, I've had people ask me, can I do 5% down on conventional financing? And no, right? So that property type does not fit the standard,
Fannie, Freddie, back to them.
Correct. Mm-hmm. And so, which means you're going,
portfolio.
Is it portfolio loan, which is going to have a higher interest rate.
Yep, and larger down.
And they're riskier components because, for example, when they're short-term rental, that's technically a second home or an investment property, right, one that you're not going to rent out long-term. So when the economy takes a dip, tourism goes to hell in a handbasket, that's a much riskier property to lend on for the lender.
Right.
And so they're gonna have more strict guidelines. They're gonna have higher rates,
and you got to put more into it. So typically we need 35% down. Sometimes we can get away with less, but usually 35 for a condotel. Yeah. Short-term rentals, if we can find a portfolio product for that, I've done them at 25% down. But yeah, condotel is usually more in.
And so what defines whether you can or cannot do a loan on a condotel?
The investor.
Even
with the...
Is it a kitchen?
Mean how...
what are the guidelines?
Yeah. Again, it depends on the investor. The local banks that we deal with, that we broker to for these, most of them want them to have a kitchen. And again...
Okay, so define the kitchen, because every time I go down this path, I have to start over from scratch.
It changes. I know, that's why. It totally changes.
So
it used to be that we could have a mini fridge and a hot plate, and that would be considered a kitchen, right? That's sort of evolved now. They're like, no, most investors are, oh, we actually want like a full refrigerator, right? We want you to have a sink. We want you to have a heating element, right? Those are right now in this moment, let's timestamp this. That's what they're saying defines a kitchen. But again, like sometimes Bank of Hawaii's definition of a kitchen is different than First Hawaiian Bank's definition or a mainland lender. So those are just the general parameters. So what we usually have to do, at least if we're dealing with the local banks, they're really aware of the property. So we can call them and say, hey, will you guys find us in this building? And they'll say, they already have a list, right? Yeah, okay, we view that as a condotel, right? We'll do it. If we're dealing with mainland banks or lenders, they're not familiar with local properties, so they have more black and white. What I've noticed coming back that went away for a while is the square footage. We're starting to see more of those. Like they want you to have a minimum of 400 or 500 square feet to finance it.
Yeah, I mean, at the end of the day, for me, whenever I'm dealing with a condotel client, I can't give them all the answers. You know, we have a discussion,
right, and
I have to tell them, like, look, we're doing financing. We got to start over from scratch every single time,
yep,
no matter what.
If every time you look at a different unit or with a different client?
Just with a different client.
Right.
It's like I could start with one client one month and
right,
another month, and I have to restart the entire process. I can have a cheat guide, but I have to go back and double check.
Yeah.
What is your requirement for a kitchen?
Right.
What to square footage? What all is mattering right now? Have your guidelines changed? When did they change?
Right.
What are they now? Is this on your approved list? Did it go off of your approved list? And it's interesting which is vastly different than normal financing.
Right.
And then on the short-term vacation rental side, how is that different from the condotel?
Well, usually to your point, it's that the property is different, right? It's not, you know, a condotel is a condominium or a hotel that's kind of been turned into a condo. Short-term rentals can be any kind of condo that allow for the short-term rental piece. And same thing. Sometimes I'll get somebody and say, okay, we'll do short-term rentals, but it can't be in the pool, right? You can't be buying one that's already in the pool. There's some portfolio lenders that say, okay, if you do that, we can't use the projected rental income to qualify you, right? Whoa. Or we can only use long-term rents to qualify you. So once you get into the portfolio world, they can do whatever they want because it's their own guidelines, right? So you start to see trends. Like I said, for a while, that square footage thing went away. I'm starting to see more of it again. So I think that's just based on risk, right? They're analyzing the deals that they're doing and say, hey, we're kind of finding that these properties that have smaller square footage or higher risk loans, right? So they want to do less of them. So I think that's why you're just seeing that those type of loan programs evolve so much over time.
Yeah. And then you come back to the hurricane.
Yeah. And do you do a lot of, do you get a lot of interest? Because I feel like, you know, you do, you have your podcast, you do a lot of, you target a lot of people that are moving to Hawaii, right? And do you feel like a lot of them are interested in condotels and short-term rentals?
I get a lot of people that want to buy a place with almost no money down.
Right, of course.
Have it make them money, and then they block off time to come and use it. And it's not realistic.
Right.
And so for me on my side, I'm constantly analyzing numbers running. I'm like the data freak.
You're the Rain Man.
So, and because I come from the investing world, so I look at real estate a little bit different than most. And I've created spreadsheets for analyzing stuff. So when I've been running numbers during COVID, that was the first time in my 25 years of investing and doing real estate here that I saw you could put 20% down and break even on property.
Because the rates were so low.
Yep. Mm-hmm. Blew my mind. Right. Now they've swung the other way and you're at 50 to 55% down to break even. Now I have seen short-term rentals. I have one listed actually where you're at about 35% down break even, which is good. Yeah, it's pretty good. Mm-hmm. With rates where they are. And as rates come down, that will be better. Right. That will improve unless prices move up because that's going to be the trade-off. So for me, it's what do we need for a minimum qualifying so then I can educate the consumer. Mm-hmm. But then there's also another component. What are you looking to do, consumer? Right. Do you want to break even or you want to be cash flow positive? Okay. That has nothing to do with the requirement from the loan portion for the down payment. Here's the minimum, but to break even, you need to be here. Right. And
so you're looking at two sets of numbers, essentially.
Yeah. But the one that we need for breaking even is higher than the down payment requirement. So someone could get a loan and go less down, but be negative cash flow. And are you okay with that?
Right.
I think the big surprise for people is they think they can put, most people, because everybody dreams of owning in Hawaii. So,
and they watch a lot of mainland television shows, I feel like that.
I think you see something and you just dream.
Right.
Right. And you're like, what can I do with,
right.
I mean, seen stuff on TV. 10% down, make money.
Or TikTok.
And the reality is we're a global destination and we're a tiny speck of islands out in the middle of the Pacific, which means we're limited in land. So we have a restricted supply.
Right.
You have a global demand. And in doing so, you're always going to be lower. That demand steps on the cap rate and compresses it. And the reason for that is because there's plenty of people that are willing to pay for it and have it just cover and use it periodically.
Right.
And so they're willing to take less of a return so it doesn't allow the market to have 6-7% returns, 8% returns like you would get in Phoenix, Arizona, San Antonio.
There aren't too many, I find, mainland states that have a lot of condotels. Like we see it in Florida, some in California, but I feel like it's it's definitely prevalent here more than any other state that I do business in. And Florida,
Yeah, I feel like Condotels fairly unique to here in Florida. But short-term vacation rental is very prevalent in other
places. But we're one of the strictest, right, in terms of our short-term rental laws.
I don't know.
Yeah.
I stand that lane. I know Hawaii.
Yeah.
And I'll ask. I mean, I keep in touch with a lot of people on the West Coast, agents on the West Coast.
Yeah.
So
from what I hear, and I'd be interested to look more into that too, but yeah, from what I hear, we are one of the more restrictive states in terms of like allowing the use or allowing people to buy and use them as short-term rentals because of I guess here, because of the hotels and the unions and all of that.
It does get more restrictive.
Right.
I mean, even the discussions now about removing that. I'm not even going to touch my thoughts on that topic, but other than the fact that we better figure out a way, from an economic standpoint, you better figure out a way to replace that money that you lose from the state because it impacts everybody.
Everybody, yeah.
And as much as we need housing, you reduce the amount of money coming into an economy, your economy shrinks.
Right.
That means you're not getting raises. It means people are getting laid off.
Yeah.
That's a tricky one.
Yeah.
I don't pay too much attention to the short-term rental market changes so much all the time from guidelines, all this.
Right.
That I don't pay attention. And it's not, I don't want to say it's not my wheelhouse. I'm good at it. But that's not my...
I was going to say, it's probably not your clientele too much either, right?
Not that. So we've talked to conventional loans, we've talked about portfolio loans, we've talked about banks, et cetera. So why don't we get into the topic now of the difference between a broker, a banker, and a bank?
Okay.
For getting your loans, right?
Sure. So a mortgage bank is a depository institution, right? So I can walk in, give you my money, open a checking account, do that. That's why I'm Hawaii, those guys. So yeah, on the mainland, Chase, Bank of America, those guys. Those are mortgage banks. They have sometimes they have some great products, niche products. Sometimes they'll decide that they really want to focus on a certain market. Hey, we want to go after the jumbo world, so we're going to make our pricing on jumbo loans really good, right? Because they essentially don't have to make the same kind of money on their mortgages as other mortgage companies because that's only a small portion of what they do, right? And it's good and bad. It's good for, in some cases, their rates and their programs in some cases, but typically it means that that's not what they do 24/7, right? It's not necessarily a priority. I think you and I both experienced doing deals with some of the local banks, and not all the time, but they can take a really long time because, again, it's not necessarily a priority, right?
No, we'll get back to that portion. Okay. So that's bank,
right?
Then we
got bankers. So a mortgage banker is, I feel like it's kind of in the middle between a bank and a broker. They have their own money. In other words, they're going to originate the loan, they're going to underwrite it, process it, and then they can decide once they close the loan if they want to sell it on the secondary market and or have somebody else service it, right? But mortgage bankers, That's all they do 24/7, right? They don't have other, they're not opening checking accounts and savings accounts. They're not financial advisors. They don't have anything to do other than do a mortgage, right? And I feel like we're a mortgage banker.
Okay.
CFG is a mortgage banker.
Okay.
Although, side note, I think I told you this the other day, the owner of my company bought a bank last week. So we're going to have a bank component to our company eventually.
Okay, so then describe, because I'm even a little unclear on this. Describe, if you're a mortgage banker, you have access to a pool of funds.
Right.
And
like a warehouse line that they basically fund our loans.
And so are they coming in? That means they're in-house loans, correct? That means you have your own guidelines.
Right.
And
we have our own products, our own guidelines, but we're selling, we are, for the most part, we do a lot of Fannie and Freddie. We do a lot of government, so VA, FHA, USDA.
Yeah.
We do a lot of those type of loans. We also have portfolio options. We can also broker. So if I have a deal I want to send to a local bank, I can do that.
Yeah, but that's not generally what mortgage banker does. They basically, mortgage banker has their own in-house pool of funds and programs that they can pick and choose from for the consumers.
Correct.
Right. And then a broker
is straight. You're getting everything from somewhere else, right?
Yeah, you're have no access. You're going to A, B, C. What do you have for programs?
Right.
What do you have for options?
What's the best rate today? Who am I going to use?
You're the condo,
and you're the middle person. Yeah.
Okay. But now, so you have in-house product options. Then you can also broker.
Correct.
Okay. Which gives you then at that point the biggest gamut of options.
I feel like I have the best of both worlds by being a mortgage banker, right? I can broker if I need to, if I don't have the product in-house. But when I go in-house, I can go directly to my processor, my underwriter. I can go to the head of underwriting. I can go to the head of my retail lock department. I have direct access to these people to get help, to ask for direction, to ask for help. We have a condo team. If you're at a broker and you want to have all these condo reviewed, that's going to be hard for you to do. You don't have a in-house condo team that says, hey, go review all these buildings that I'm not even in contract on,
So then would you call yourself a mortgage banker broker? Because you are overlapping it.
Yeah, and I'm about to be able to call myself a mortgage banker broker bank. We'll see what that looks like later, but yeah.
And hopefully not the jack of all trades.
That's none.
Right?
Yeah.
Okay. So that's good to understand now the pros and cons.
Yeah.
The pros of the bank are the portfolio options. What are the pros?
Well, and let me ask you this. You've worked with the gamut too. Yeah. You're not allowed to work with other people, but I know on occasion I let you. And when you do, you work with brokers, you work with other bankers, and you work with banks. Like, from your standpoint, like, what difference do you feel, if anything?
Obviously having the gamut of selections, right? Everybody wants the best rates and the best loan program. Mm-hmm. So obviously you want to have the widest net for selection options. So obviously that's important. You also, one of the frustrations that I used to run into, and I would mention this to banks, you'd have your lender and your underwriter is some other building downtown, like some box. They can't talk.
They're not allowed to talk. Right.
And I remember during COVID, a lot of them weren't even taking, wouldn't take your loan if it wasn't a minimum of like 60-day closing. And I'm like, hello, you can't compete.
Right.
In this kind of
market. Already competitive, and now you just added
we got 44 offers on this property.
Right.
And the only way we can do it is if we have an extra long closing that's not appealing to the seller.
Yeah.
And so the banks wanted to keep the underwriter and the lender separate because they want to cover the bank's overlay over here. And what causes problems is if they can't talk, if this person doesn't get it exactly right, then it can fall apart or it gets dragged. And that was one of the things, was just the process was so slow. Now, they've worked on it.
Yeah.
And the higher up you are within the banking component, if you're in private banking, that process, you have someone that hand holds that
and keeps moving along quicker. Yeah.
And then if you're, I have clients that have high net worth clients that have good banking relationships.
Right.
And so there's options for them in different categories that could be very appealing.
Right.
But in general, on the banking side, I've had more frustrations during the process than I have had smoothness.
Right.
And that gets frustrating.
Right.
On the broker side, the appeal obviously is the wide net.
Right.
But where we've sometimes run into difficulty is where you are the conduit, you are the third person. We're solely dependent on that, whoever you're brokering it to, and at their mercy.
Right.
Right? Because you don't have control. It's not your program. You're going to somebody else's program and you're acting as the middleman. That's where you can run into some challenges and the difficulties. Right. It just kind of depends, it's.
Yeah. And sometimes you don't have an option, or sometimes I don't have an option, right?
Yeah.
I just closed a deal yesterday that was a total nightmare that I brokered. And the only reason I brokered was because they were the only investor that we could find that would do a particular condo. And it just it was
Grind through it.
Yeah, it was rough. It was rough. So, but I like the fact that I have all of those options, right? I feel like if you bring somebody to me, I pretty much can find something for anybody, right?
Well, and that's why you and I are on the phone so often, and I'm like, hey, here's a scenario. What are you thinking? And so I have to do that because when I sit down with a consultation, we're trying to strategize. I'm trying to strategize with them. Like, here's the path. Mm-hmm. Here's where we need to be aware of. This is what we need to pregame for, so that it's smooth for them. It's less stressful, and we can get there and fully accomplish it. There's nothing worse than going down the path for a couple of months, get into escrow, and something blows the thing up. That's not only frustrating, but then they've lost money.
Right. Yes. And I think you and I can say, you have a track record that in the 20-something years we've been working together, we've never had a deal fail. Yeah.
Correct.
Because of us. Like maybe if something happens with the home inspection or whatever, but not because of the financing.
Not something that we weren't. Well, and that's a part of it is it's that game planning. Right. It's again, it goes back to it's important who you work with throughout the entire team. I always say it this way, like you, as a consumer, the first thing that you should be doing is getting your team of experts around you before you try to start the process. And a lot of times in this industry, the industry has taught the consumer, hey, I want to see this property, get in the car and go show them. It's like, no, that's not in your best interest. It's not in my best interest. Let's sit down. Okay, we're missing this piece of the puzzle. We need to get that together. Because if you want the best deal, you get prepared up front. Right. Because if you don't, you're going to pay more. Right. Or you're gonna waste money. Yeah. All right. So let's get to our last topic then, which is interesting for me because Josh Green, I call it the Josh Green bill because that's the one that resonated with me. Right. They passed a bill recently, and they were touting it as helping with affordable housing. And part of the component was that you were going to be able to build 2 ADUs, accessory dwelling units, additional units on a residential property. Right. So you could have potentially the main dwelling and 2 smaller legal dwellings. Right. And they were saying this would be a help for fixing affordable housing. Mm-hmm. And for me, I don't agree with it at all for a lot of reasons. But
soapbox.
Yeah, where's my soapbox? I'll give you the example. I mean, I just purchased the property, fixer-upper, roughly $1.2 million. I'm going to fix it up, and then I'm going to build an ADU. Right. That house would then be worth $1.8 million. That's not more affordable than one of my original purchase prices. Right. That's significantly more expensive. Now, can I supplement my mortgage? Absolutely. But the goal should be homeownership. And the other component is when I go to sell that at that point, should I ever sell it, if I go to sell and go away, someone is having to purchase a $1.8 million property, not a $1.2 million property. And so
because you can't sell them separately.
Yeah, you can't subdivide them, you can't CPR them. Right. So my question for you is, how does financing work on that? Is it you now have 2 dwellings on a property? Does that conform to Fannie and Freddie, which is going to be your best rates, your best programs, and the bulk of the loan programs, or do you have to go portfolio?
So, usually you hear me say Fannie and Freddie a lot, right? They're always together. The reality is they're two separate entities who actually have separate guidelines. I'd say 75% of their guidelines are the same, right? They follow the same requirements. 25% of it, you're going to have a variant in one way or the other, which is actually helpful, right? Because sometimes I'm going down the path on Fannie and I realize, oh my gosh, this guy's student loan debt is different than I thought. So I'm going to switch to Freddie because Freddie has less restrictive guidelines on student loan debt, right? So same thing with ADU. So right now, again, let's timestamp this because this could change tomorrow. But right now, Freddie will allow us to count income on from an ADU.
So if
to help qualify or offset a mortgage.
So if I rented out the ADU for X amount a month, Freddie will allow me to use that income to qualify for the property. Fannie
will not.
So you've eliminated.
They will if you do home ready. They have a home ready program, which is a more affordable, like a first-time homebuyer program.
Oh, so, first-time homebuyer.
Right. Yeah. Well, see, and that was my other piece I was going to tell you. So right now, conforming is 1149825, right? So if you're in the $1.8 million range, you're already
because conforming caps at
$1,1149825.
Yes. So if you want to get a Fannie or Freddie loan,
your loan amount can't be over.
The loan amount cannot be over that.
If it's $1 over that, that's considered a jumbo loan. Right. So different guidelines, higher down payment, different restrictions.
Yeah, totally different loan program.
We're back to the portfolio piece we've been talking about.
And so Freddie, you have some loan programs that will fit where with the ADU, do you know if the ADU would have to be rented out at the time that you're going to purchase it? Could it be empty? Okay. So then the appraiser's doing a market rate. Rent comp for long-term rents on that. And then they're factored.
We can use a percentage of that. Right.
Yeah. Right. Interesting. And the reality is unless you're coming in with a huge amount down then, because what is the conforming loan amount right now?
11498.
1149. So if you're going to buy a home in
1.15 essentially. That's to make it even.
Yeah.
Kind of.
So if you're going to buy a home in Metro Honolulu that has an accessory dwelling unit, I can already tell you you're going to be in close to that 1.8 range. Right. Give or take $200,000, bro.
Right.
Which means if you want to do a conventional loan with Freddie, only Freddie is doing, and you're capped at 115, let's call it. The rest of that money has to come in cash.
Right. And how many people fit that category?
So my point is how does that help improve affordable housing here? It doesn't.
So is that kind of what bugs you? Like what? Because I know that this bill bugged you because we've discussed it on multiple times. So what is it about that was? Because I do feel like being able to have an ADU for some people like allows them to have family live on the property or things like that, right?
You can do that now.
Right. But can you do it so what does this bill do that is, first of all, different than what we used to be able to do? And then why, two parts to my question, why does it
bug me?
Yeah.
So there's two components. For one, the concept of the bill itself I like.
Okay.
Because what it says is that they're going to try to allow for more density in the urban district. Now, urban district, when people think urban, they think Honolulu. But when it comes to land use ordinance, urban district is not the same. There is areas in Waianae, Leeward Coast, Haleiwa, Hauula that are classified as urban districts, right?
That's like USDA financing areas.
No, I thought USDA was
rural, but all those areas you just said are
rural.
Yeah, well, they're USDA.
Well, so that rural and land use ordinance, like totally different. But what I'm talking about is from a planning standpoint on Oahu, you have different classifications. And so my argument is it's urban districts encompass residential areas.
Right.
I don't think that you should go into your residential areas until you've infilled the urban area. There are a number of 2- and 3-story walk-ups in the urban area that would be better off becoming 400-foot condo towers. Condo towers are more affordable than single-family homes.
Right.
So in that component, put it there, right? You become the boroughs of New York at that point, where you stay in your borough and you avoid the urban area from driving. But the minute you go into the residential, there's two components why I didn't care for that. For one, Brian Schott said, we've got to stop worrying about the aesthetics of the neighborhood. And I was like, it's not aesthetics. It's infrastructure, right? You drive around Kamiki, Kapahulu here. I can't go down certain roads because it's full of cars because people either have illegal units or they have an ADU or an Ohana, and their cars are spilling out into the street. Okay, that's with one dwelling and then an ADU. Okay, now you're going to allow a second one, and it's in the residential area. That doesn't make sense to me. Keep it in the urban infill. Go vertical. That's what we're designed for. We're limited to land here. The other component is we already have 12,000 permits backlogged with DPP with over a year wait for a permit. We need 50,000 units to correct the affordable housing component. You're going to add a one-off system of people. I go to add an ADU, I just chipped away at one.
Right.
When we're already a year behind. So if you had the 50,000 people go and apply for permits for ADUs, was it 5 years to get a permit?
That's a whole nother topic I think we should.
But
sometime. The whole permitting nightmare.
Oh, absolutely.
Yeah. Then you'll definitely be.
It's why I won't do new construction.
Right.
And so I actually have the desire to bring investors in to add to the inventory in an affordable way.
Right.
And I won't do it because I can't trust. I can't trust that system. So the workaround is you buy a fixer. You do a repair permit so you can get in. You don't have to submit plans and permits. It's online. So now I can immediately start construction. And then
okay, wait. So say that again. I didn't know that.
You can't move walls. Okay. You can't add
under the repair permit.
Correct.
Okay.
You're basically, it's just what it is. You're repairing. You're changing like for like.
I see. Okay.
Now there's other components to that are modifications of it, but you can't go in and gut the interior, move walls around, add bedrooms, add bathrooms, all that stuff.
Okay.
You're not allowed to do that. So,
but that you can get that permit, a repair permit, you can get quickly.
Yeah. You just fill it out.
Okay.
Immediate.
Okay.
We're going down a rabbit hole.
Okay. But no, I think it's interesting though, because I don't know, I didn't know any of that. I thought like basically, if you got any kind of permit, it took forever.
No.
You know. Okay.
Electrical and a plumbing permit, you do that. Those are online. You got to do a split AC permit components. It's online. You fill out some stuff, click pay, and you're done.
I didn't know that.
Mm-hmm.
Okay.
Because, even with your mechanical plumbing, when I go to submit brand new drawings for a new build,
right,
residential side does not require the plumbing drawings on there.
Okay.
Yeah. So which is an interesting topic because for me,
well, and you're a total expert at that. You do that all the time.
No, I wouldn't call myself an expert, but I read 13 construction books before I stepped on my Haula project. At no point did I ever think I was a contractor.
Right.
But I did work with them. I did concrete, roofing, framing, windows, siding, the whole 9 yards. And my knowledge base on that side is significantly high, plus material procurement, plus land use zoning. Like I understand all that.
Right.
Which then when I bring it over to the sales side, okay, that's a differentiator for me. Who has that skill set? And I liken it this way, and this is one of the issues that I have with our industry. Companies tell agents, don't explain the condo docs. They don't want the liability. Okay, well, if we're not to do
release, I didn't know they.
Oh yeah, they don't want the liability. You're not the expert in this area.
So you're supposed to explain those. Oh, you're supposed to translate.
Go hire an attorney.
Oh, really?
That's what they tell you. Now, at that point, what's your value?
Right.
What are you, Vanna White? Do you like this cabinet? Right. And so then if that's all your value is, or very limited, then your pay should be aligned with that. Yeah. And that's where I've, over all these years and decades, have aligned myself. So now I walk through a home with a client, I understand how that's constructed.
Right.
I know what the glulam beam is versus a TGI. I also understand costing on it because I've done all the material procurement. I mean, I remember Haula, we're running over $100,000 a month on the credit card. I mean, it's just like it's nothing, but that's because the investor money is there.
Right.
But that allows me to bring a different service to the consumer at that point. And construction is a part of a home, right? So if we're selling real estate, side setbacks, height restrictions, What is the zoning? All those things to me come into play in understanding what you're buying and where are some potential pitfalls. What do we need to be careful of? Does that deck go into the side setback? And what does that mean? How is that a concern for you, or is it?
Right.
And what are the implications? So part of that was I'll give you a quick story. Kailua client bought a property that had been a flip, looked beautiful, walked in, and I'm like, wow, the space is really open. Looked, they had bought it 3 months before. There were no permits pulled, and turned around and sold it. Same listing agent. And I'm like, okay, they didn't pull permits and they did a full gut, and I could tell they moved walls. And then there was a separate unit where it looked like a garage used to be, and it was walled off from the other side. So now you have two separate dwellings, which I know from a lending standpoint doesn't work.
Right.
And so then they had put the 220 plug in for the range in the wet bar. The problem is 3 years ago, the county got rid of the range as an option in the wet bar.
Right.
So you're limited in refrigerator size now and sink only, and you cannot have a 220, because what everybody would do is they put the 220 in and not put the stove there. They'd have the sink in the refrigerator.
Right.
Then when he closed the... So all these things I started to see, I'm like, those are all construction things. Most agents aren't going to know that. So then I went down to DPP, pulled all the plans. I could see then from an older house layout how they had moved everything.
Right.
And I'm like, what guarantee do we have? It's nice, shiny, and new, looks great, but what guarantee do we have? Now we got one illegal unit. None of this has been permitted. And if they get turned in, when we started walking through with the client, like, here's your consequence. You're going to lose the illegal unit if you use that. And you're going to have to bring everything up to code plus triple the permitting fee. And it came out to probably 120 grand. And so my client at that time said, I don't need this grenade to blow up in my hands. So we're going to move on.
Right.
But those are the components that buyer beware, right? And it matters who you work with.
Yeah.
And how much knowledge and experience can I bring to the table for that consumer, because there's a whole bunch of other things other than just buying the home that go into real estate.
That's a great example.
So you have any last thoughts or any last things you want to say, Keri, before we get out of here?
I just think that, I mean, it's the underlying theme of our relationship, right? That it's not just about, a rate or, the amount of times I get somebody, I literally had a call yesterday. Hey, it was a realtor. What is your today's rate? I'm like, it's more than just interest rate. Interest rate matters. But there's, a whole nother world behind it of, working with professionals and working with people who know what they're doing. And it doesn't have to be us, but you need to do your due diligence and make sure you're partnering with the right realtors, the right lenders, the right everything in order, because it's for most people the largest transaction of their life.
Yep.
So,
yeah, I go back to saying it, who you hire matters. Surround yourself with the right team up front.
Right.
For all the pieces of the puzzle before, and have that game plan set up before you go forward. So which means interviewing people. And a lot of times I see people skip that process of interview, and they just assume that everybody has a license, they're good.
Yeah.
Which we know in this industry they're always changing, shifting. The market is constantly changing. So it's good to sit down with someone and understand, if you're buying, for example, and understand, okay, what does it take to buy in today's market? Because it's different than yesterday's market, and it's going to be different than tomorrow's. And in doing so, interview people, but make sure you're surrounded with the right team of professionals.
Yep.
And that's why we've worked together for so long, is because I don't think there's a day that we're not on the phone discussing
talking through something. Yeah.
Mm-hmm.
What about you? Do you have any parting words?
That was pretty much it right there. I mean, it comes down to who you...
We're on the same page for sure when it comes to all that stuff.
Yep. Thanks for joining me.
Yeah.
And your contact info we'll put on the screen here.
Okay.
And you can get in touch with Keri if you ever have any financing or lending needs.
Thanks, Scott.
Thank you.